Welcome back to Canada Accounting Insights. Today, we're diving into a concept that every accountant, CPA student, and bookkeepers needs to master: accounts receivable. Now, I know this might sound a little dry at first, but trust me, by the end of this video, you'll have a clear picture of what accounts receivable are: initial and subsequent measurement, impairment and disclosure, and at the end, I will also explain the slightly differences of how it is treated under IFRS 9 and ISPE 3856. But first, hit the like button and subscribe to help to grow the channel. All right, let's get started. So first things first, what exactly are accounts receivable? In simple terms, they're the amounts customers owe you because you sold them goods or services on credit. Instead of paying cash up front, they pay on account. These are also called trade receivables, and since most are collected within about 30 days, they appear as a current asset on the balance sheet. But there's also a second category: non-trade receivables. These are amounts that don't come from sales, things like tax refunds from the government, employee advances, or insurance claims. Here's the key: the accounting rules are the same for both trade and non-trade receivables. And one last point here: most companies track receivables in a subledger. This makes it easy to see exactly who owes money, follow up on collections, and turn sales into cash faster. Now that we know what AR actually are, let's talk about how we first measure them. Receivables are recognized as an asset when the seller has a legal right to cash. In practice, that's when you've delivered the good or service. In other words, when you've earned the revenue. At that point, AR are recorded at the transaction price, which is the fair value at the date of sale. But recognizing a receivable is just the beginning. Next, we need to understand payment terms and how discounts are handled. Have you ever seen terms like 2 out of 10, net 30? That simply means the customer gets a 2% discount if they pay within 10 days. Otherwise, the full amount is due in 30 days. Now here's the twist. We have two ways to record these transactions: the gross method and the net method. Let's look at this example. A company makes $60,000 of sales with terms 110, net 30. The customer pays $9,900 within 10 days and $50,000 after the discount period. Here is how the journal entry would look like in both gross and net method. In practice, the gross method is more common because it's simpler, but the net method is more accurate if discounts are significant. Okay, so we know how receivables are recorded at the start. But what happens if customers don't actually pay? Receivables are subsequently measured at something called net realizable value, or NRV. That means the actual amount you expect to collect. For example, a company records $15,000 in receivables. Later, management realizes they'll probably only collect $10,000. The AR is reduced to $10,000. A $5,000 bad debt expense is recognized. So the carrying amount always reflects reality, not just hope. But how do we anticipate losses in advance? That's where the allowance for doubtful accounts comes in. Instead of waiting until a customer defaults, accounting rules require us to estimate bad debts early. We do this using a contra-asset account called Allowance for Doubtful Accounts, or AFDA. For example, imagine a customer owes us $50,000, but things are looking shaky, and we now think we'll be lucky to get $20,000. That $30,000 difference, that's an impairment, and we have to get it on the books. Receivables are presented net of AFDA, and the amount of AFDA must be disclosed either on the face of the balance sheet or in the notes. Now, the big question: how do we actually estimate that allowance? There are two common methods: balance sheet and income statement approach. This is the key distinction. Listen up. The income statement approach is all about calculating the bad debt expense for the period. The balance sheet approach, on the other hand, is focused in calculating what the final ending balance in the allowance account should be. On the balance sheet method, you sort all your receivables by how old they are, and the logic is simple. The older the debt is, the less likely you are to collect it, right? So, you apply the higher uncollectible percentage to the older buckets. The total you get $15,000 here is your target ending balance for the allowance. Your bad debt expense is then whatever number you need to plug in to make the allowance balance to hit that target. In practice, the income statement method is quick and often used during the year. The balance sheet method is required at year-end for accuracy. So we've estimated losses. But what about receivables that are written off completely or even recovered? Receivables leave the books in three ways. They're collected, they're written off, or they're sold to a third party, also called factoring. Suppose that we have lost our hopes to receive a certain amount from our customer. At that point, we decide that that account receivable is uncollectible, and we perform what is called a write-off. Let's see how the journal entry looks like. We debit the allowance for doubtful account, and we credit that specific customer account's receivable. What this does is remove that bad receivable from our books, and it uses that piece of allowance that we had already set aside for exactly this kind of situation. And if they surprise you and pay later, so you have to record it in two steps. You first reinstate the receivable, then record the cash. This keeps the audit trail clean. Now, before we wrap up, let's quickly touch on how IFRS and ASPE handle receivables. Under both systems, receivables must be assessed for impairment at each reporting date, but the approach is different. Under IFRS, we use the expected credit loss model. That means you look forward and estimate possible future defaults, even if no specific account looks bad yet. Under ASPE, you assess whether there are indicators of impairment at the reporting date. For example, overdue balances or concerns about a customer's financial health. Now, ASPE3856 also gives guidance on how to calculate net realizable value. Receivables should be adjusted to the highest of three amounts. A. The present value of expected cash flows. B. The amount you could get if you sold the receivables today. C. The amount expected if you exercised rights to any collateral. But here's the thing. In practice, option A almost always applies. Most receivables are due within 1 year, so there's no discounting. Selling receivables usually brings in less than collecting them, and trade receivables rarely have collateral. So practically, under ASPE, receivables end up valued in much the same way as under IFRS. The only real difference is that IFRS requires the expected credit loss model, while ASPE focuses on impairment indicators. And that brings us full circle, from what receivables are, all the way through definition, measurement, impairment, and even IFRS versus ASPE differences. So there you have it, everything you need to know about accounts receivable. If this breakdown helped you, give the video a like, subscribe to the channel, and let me know in the comments. Do you want me to cover factoring receivables, or should we move into notes receivable and long-term financing next? Thanks for watching, and I'll see you in the next video.